Alright guys, so before I begin the video, I just want to explain how this PowerPoint works. So you guys can actually download it in the description and you guys can follow along at your own pace. So let's say if you're doing examples for your income statement and you want to look quickly at the step-by-step guide, you could just go hover over this square, just click it, and it brings you to the steps. So you could just go through all the steps, you could see everything, you could see your template, and if you want to go back, you could just click the map, and then there you go. If you guys are also in the other view, if you do control click, it also works as well. So you can do it with anything, target operating income, go through all the steps, go back, and that's it. If you want to look at the formulas, it's the exact same thing. So let's go to the video. Guys, welcome back. Today I'm going to be doing chapter 6 of 305, cost volume profit. So we're going to be looking at a cost volume profit, just an overview of what it is. We're going to be looking at an income statement, 3, the break-even analysis, our target operating income and the required sales, 5, margin of safety, and then we're going to end it with our operating leverage. So first, let's start with cost volume profit. So what is cost volume profit, or CVP? It's a method to understand how the relationship in cost, sales volume, and price affect a company's profit. When is cost volume profit used? Well, it's used for determining pricing strategies like selecting product mixes, production levels, evaluating projects, budgeting, forecasting, and planning. So let's look at cost volume profit income statement. So what are the key definitions of a CVP income statement? Well, a CVP income statement is a financial report classifying costs into fixed and variable costs and calculating the contribution margin. So fixed costs, these are costs that do not change with the level of production or volume. Variable costs, these are costs that will change with the production level or volume. So variable cost per unit is equal to total variable cost divided by the total units produced. Next, we have the sales revenue. This is total income generated from selling goods or services. Sales revenue can be calculated by the total units sold times your selling price per unit. Next, we have the contribution margin. This represents the portion of sales not consumed by variable costs and contributed to fixed costs. Contribution margin equals to sales revenue minus total variable cost. And if these definitions might sound confusing or if it's a lot to understand, once we do a lot of examples and I'll show you the income statement, it might look a lot easier to understand. So contribution margin per unit, this is the money left from sales after paying to make the product. Contribution margin per unit, this is equal to unit selling price minus unit variable costs. So contribution margin ratio, this is how much of your sales money helps pay for fixed costs. Contribution margin ratio is equal to contribution margin per unit divided by your unit selling price, or just contribution margin divided by sales. So your operating income, this is the profit remaining after variable costs and fixed costs are subtracted from sales revenue. Operating income can be calculated by doing contribution margin minus fixed costs. So here's a step-by-step guide on how to find your income statement or how to create one. So step 1, calculate your sales revenue. So you can use the formula sales revenue is equal to total units sold times selling price per unit. Step 2, you want to calculate your variable costs. Step 3 is to calculate your contribution margin. Step 4 is to calculate your total fixed costs. And then step 5 to calculate your operating income. And then step 6, you want to calculate your per unit. So you'll have 2 columns, one for just total sales and then one for per unit. And once you see the template, this is what I mean. So you guys can see here, if I draw, so you would calculate your total. Let me get the pen. So you calculate your total for your sales. So this is A. Then your variable cost, which is B. So A, B, and then C is equal to A minus B. And then you find your fixed cost. So this would be step 4 right over here. And then you calculate step 5 by doing your contribution margin, so C minus D. As you can see here, contribution margin minus fixed cost. And just to find the per unit, what you could do here is looking at step 6, is just do your total divided by your the total number of units that you have. So just do that for every single one, except for your fixed costs. Your fixed costs always stay the same. So just look at that. Make sure you guys remember this because it's very important. You don't want to make a mistake like that. And yeah. So 3, break-even analysis, a basic overview. So what is a break-even analysis? The definition, it's the level of sales at which there is zero profit or loss. Break-even is where total revenues equals total costs. The break-even helps businesses determine the minimum sales volume to avoid losses. That's the main goal. We don't want to avoid losses. So how do we calculate the break-even? Well, first there are 2 methods. First, it's the break-even in units. So this is total fixed cost divided by your contribution margin per unit, or your total fixed cost divided by your unit selling price minus unit variable costs. Step 2, it's your break-even sales. So this is in dollar amount. So total fixed cost divided by your contribution margin ratio. So let's look at a step-by-step guide. So step 1, find your knowns, your fixed costs and your variable costs. This might be given, or usually it's given in a question. Then step 2, calculate the contribution margin. So looking at these formulas, either your per unit or your ratio. In some cases, you might have to find both depending on the next step. And then step 3, calculate the break-even point. So if you're trying to find your break-even units, you have to use your contribution margin per unit. If you want to find your break-even in sales, you want to find your contribution margin ratio. And in step 4, you want to create an answer or analysis on the amount of units or amount of dollars sold to break even. All right, guys, we're going to be taking a look at our break-even point in units and sales example. So let's see the example we have here. So company A manufactures and sells product 1. Company A sells product 1 for $50 each. Product 1 has a variable cost of $30. The total fixed cost to produce product 1 is $60,000. So we want to find what is the break-even point in units and sales. So the first thing I'm going to do is to create our CVP income statement. And usually when we're calculating our break-even point, we would already have this created. But since this is, we're pretending like it's a new question, I'll just create it. So we have our total and our per unit. And then we have our sales, our variable costs. We have our contribution margin. We have our fixed cost and then operating income. All right. So what we can do here is just fill in our known. So our sales is what we're given on the second line. So right here. So it's $50. Our variable cost is given on the third line. So $30. Our contribution margin, we can calculate this by doing equal sign sales minus your variable cost. So that's 20. Your fixed cost, this is given, so it's 60,000. And just make sure that you're putting it in your per unit, since that's what they're giving us. They're giving us for only one. For each unit, they're giving it to us. If it would say like company A sells product 1 for a total of like, let's say 100,000, then we would put it here 100,000. But since they're saying for $50 each, we put under the per unit column. And so our operating income, we actually can't calculate. So I'll put a question mark. And our fixed cost, this is just equal to our per unit cost. Fixed cost just never changes. All right, since we just did step 1, which is to find our knowns, fixed cost and variable cost, we can do step 2 to calculate the contribution margin. And we found one part of the contribution margin. This is our per unit. So the contribution margin per unit is equal to 20. And just a reminder how we got 20, it's sales minus variable costs per unit. That's how we got 20. And now we want to find our contribution margin ratio. And to do this, it's our contribution margin per unit divided by our sales per unit. And it's just very easy. You're just doing your contribution margin. So I'll change this to that. So your contribution margin per unit divided by sales. And it gives you 0.4. So now we can actually calculate our break-even point. So this gives us to step 3 to calculate the break-even point. All right, so we want to find first our break-even point in units. So I'll just write the formula down. So break-even point in units is equal to total fixed costs divided by contribution margin per unit. And since our break-even point formula is either for units and sales, doesn't include our income, operating income, it's not important in this example for us to know what our operating income is. So our total fixed costs is 60,000. This is given to us, and our contribution margin per unit, this is what we calculated in step 2. So now we can calculate our break-even point in units. And it's just total fixed cost divided by our contribution margin per unit. So it's 3,000 units. I'll put this like that. So now we want to find our break-even point in sales. This is equal to our total fixed costs divided by the contribution margin ratio. The total fixed cost is always going to remain the same. Just remember that, 60,000. Our contribution margin ratio is what we calculated in step 2. So like I said before, step 2 is very important for us when we're doing step 3. And now, so our break-even point in sales, total fixed cost divided by a contribution margin ratio, and that gives us into dollars. So step 4, answer. So for company A to break even, they must sell 3,000 units, or they must sell for a total of $150,000. So for target operating income / required sales. So what is a target operating income? Well, the definition is the profit a company aims to achieve in a specific period. A target operating income is a financial goal. So an example, a pen company wants to achieve a target operating income of $10,000 for the upcoming fiscal year. This is their financial goal. So how do we find sales to accomplish target operating income before tax? And this is a very key information, before tax. So required sales in units, this is equal to your fixed costs plus your target operating income before tax divided by your contribution margin per unit. Then required sales in dollars, this is your fixed cost plus your target operating income before tax divided by your contribution ratio. So as you can see in the formulas, the top part, so this part is always going to be the same. And the only thing that changes is either your per unit or your ratio. So depending, if you want to find your dollars, you're going to be using your ratio. And if you want to find your units, you're going to be using your per unit contribution margin. And then operating income after tax, in case they ask you, let's say in a question, what is our operating income after taxes? Well, if they give you a tax rate, you would use your operating income before tax times 1 minus your tax rate. And then let's say if we need to calculate our before tax, because in this case, all these formulas need to be calculated with the before tax. If they give you your operating income after tax, we can find our before tax by doing operating income after tax divided by 1 minus the tax rate. And usually they'll be giving you the tax rate in the question. So here's a step-by-step guide. So step 1, calculate your fixed and variable costs. Step 2, calculate your contribution margin. Step 3, identify target operating income before tax. And then step 4, calculate required sales. All right, guys, so we're going to be doing a required sales example. So we have here company A makes products that sell for $56 each. Company expects fixed cost to be $320,000 and variable cost to be $42 per unit. So A, calculate the sales dollars required to earn operating income of $410,000 before taxes. So we're going to be trying to find sales dollar per unit and in dollars. So let's follow the steps given in the PowerPoint. So step 1, let's calculate our fixed and variable costs. We have fixed cost. This is given to us, which is 320,000. And we have our variable cost. This is $42. I'll put this in dollars. And so now step 2, let's calculate our contribution margin. And our formula is contribution margin is equal, or contribution margin per unit we'll calculate first is equal to unit selling price minus unit variable cost. And so our unit selling price, this is $56. Our unit variable cost is 42. This is given up in the top line right here. So our contribution margin per unit, make that bigger, is equal to unit selling price. So if you guys aren't used to Excel, you could just click on any cell. So we're going to put it here. You just click your equal sign. You want to select the unit selling price, so the number 56. Click the minus button and then click 42. And then just click enter, and that gives you your answer. So just to make it more neat, I'm going to put a border, and I'm also going to fill in the color. So now we want to calculate, I'll write the formula, our contribution margin ratio. This is our contribution margin per unit divided by unit selling price. So our contribution margin per unit is what we just calculated. So once again, you just go in the cell that you want the answer to be in. You click equal sign and then click your answer. So in this case 14, and it copy pastes the answer. So unit selling price is 56. And so our contribution margin ratio is equal to our unit selling our contribution margin per unit divided by our unit selling price. So that's 25. And once again, I'll put a border. I'll put it in orange. You guys can see that's an answer. So step 3, let's identify our target operating income before tax. And this is given in the question. So our target operating income before tax is 410,000. And so in some cases, they might give you, let's say, they'll give you a target operating income after tax. And all you have to do is just plug in your after tax that they're given to you. Let's say 410 was the actual income after tax. You would plug this into the formula in the PowerPoint that gives you your, or calculates your target operating income before tax, and that's what you want to use. So in these questions, and whenever you're going through these things, you never want to actually use operating income after tax. You always want to try to find your before tax. So just make sure that this is very important. So now let's go to step 4. You can calculate our required sales. I'll write the formulas for both of them. So required sales in units is equal to fixed cost, and make sure you guys include your brackets, plus target operating income before tax divided by contribution margin per unit. In the formula, I'll go down a little more. Our formula for required sales in dollars is equal to fixed cost plus target operating income before tax, close the brackets, divided by our contribution margin ratio. So whenever you guys see, if we're using the ratio, that means we're going to be working in dollars. And if we're using our per unit, we're going to be working in units. So that's just a good way to memorize in case you guys forget the formula. Just remember dollars. If you're trying to find your dollars, you want to use your ratio. If you want to find your units, you're using the units. So let's write the stuff that we know. So fixed cost, this is equal to what we calculated on top, 320,000. Our target operating income before tax. This is what we just calculated, the 410. I'll put this in orange as well. And then we can see we have our contribution margin per unit. Click the equal sign. This is what we calculated in step 2. And then contribution margin ratio. This is what we also calculated in step 2. So now it makes it really easy. So the required sales in units. This is equal, and don't forget to include your bracket. So fixed cost plus target operating income divided by your contribution margin per unit. You just click all three, click enter, and that should give you your sales in units. So this shouldn't be in dollars, it'll be in units. And here we have our required sales in dollars, and this is equal to, open your brackets, fixed cost is right here, plus target operating income before tax, close the brackets, divided by contribution margin ratio, and that should give it in dollars. And so this is the right answer. And if you guys want to double check this, a good way is, let's say I'm not too sure if my units and my dollars are right. So if I click this, sales in units, I do the star button, or the asterisk, this means time. So I want to do our amount of units times the amount we sell it for, which is 56. And then I just click enter, and as you can see, they equal the same thing. So if that equals the same thing, that means you know you calculated right. And that's pretty much it. So 5, margin of safety. What is a margin of safety? Well, it's a measure of how much sales can decrease before a loss occurs. An example of this is if a pen company projects to sell 18,000 pens, they can afford to sell 8,000 fewer pens than projected before they start losing money. So this is very important, as you know, at what level can we expect if our projections are under projected. So how do we calculate margin of safety? So margin of safety in dollars, this is equal to your actual or expected sales minus your break-even sales. And then your margin of safety ratio, this is your margin of safety in dollars divided by the actual expected sales. So let's look at a step-by-step guide. So step 1, determine the actual or expected sales. Step 2, calculate the break-even point. Step 3, calculate your margin of safety. All right, guys, so we're going to be doing a margin of safety example. So continuing from our last example, we're going to be finding the margin of safety in dollars and as a percentage, assuming actual sales are 1,382,400. So let's follow the steps given in the PowerPoint. So step 1, let's determine actual or expected sales. So we can see that our actual sales is given 382,400. It's right in the question here. And then, so that brings us to step 2. Step 2 is to calculate the break-even point. And so let's write the formula. So the break-even point in sales is equal to total fixed costs divided by your contribution margin ratio. And so our fixed cost is given from on top. If you guys remember the question that we did before about required sales, and then the contribution margin ratio is what we calculated the previous example. So write 0.25. And so our break even point in sales, total fixed cost divided by contribution margin ratio. So 1,280,000. So this brings us to step 3 to calculate our margin of safety. And so the formula for the margin of safety in dollars is equal to actual sales minus break-even sales. And so our actual sales is equal to 1 million. So up here, 1,382,400. And then our break-even sales is 1,280,000. So our margin of safety in dollars is equal to our actual. So just click the equal sign, click the number you want, click the minus, and then click the second number. So break-even sales. And this is our margin of safety in dollars. I'll put this orange again. And now we want to find our margin of safety ratio. So let's write the formula. It's equal to the margin of safety in dollars divided by actual sales. So margin of safety in dollars is what we just calculated, and our actual sales is equal to that in the beginning. So our margin of safety ratio is just a margin of safety in dollars divided by actual sales. You can see 0.07. So that's it for this question. The last one, 6, operating leverage. So what is operating leverage? It's a measure of how sensitive a company's operating income is to change in sales volume. Operating leverage is tied to the company's cost structure, which is the ratio of fixed and variable costs. High operating leverage is when fixed cost is greater than variable costs. A small increase, and what this means is a small increase in sales leads to a large increase in operating profit. A small decrease in sales leads to a large decrease, so they follow each other. Low operating leverage when variable cost is greater than your fixed cost. This implies that a small increase in sales leads to a small increase in operating profit. A small decrease in sales leads to a small decrease in operating profit. So degree of operating leverage, this is equal to your contribution margin divided by your operating income. This is pretty straightforward to calculate, as you can calculate this from your income statement. And then your percentage change in operating income, this is the degree of operating leverage times your percentage change in sales. So these are all the formulas that you'll be needing for this chapter. If you guys have any questions, just leave a comment below and I'll happily reply. Thank you.